Hi. Well, let's go ahead and get started. Our topic for today is about the IRS Collection Division. Before we begin, as instructed, please pause the tape and print all the forms, the filled-in form 433A, National Standards for food and clothing, housing utilities, and then the national standards for the housing and the local standards for transportation. We need those. I need to demonstrate how you fill out the form 433A. It's very important. So go ahead, pause the tape, and when you have printed all of them, please go ahead and get started, and we'll get going. Okay, I assume you would have, by now, you've printed everything. Let's take a general look at the entire collection division of the IRS. The collection division of the Internal Revenue Service is placed in place pretty much to collect back taxes owed. Whether you owe for 1 year or multiple years, it's all the same thing. Everything that we will be discussing here applies to the same thing. Meaning whether you owe $1,000 for 1 year or $1 million or $1 billion for multiple years, it doesn't matter. A monthly payment plan, usually it goes by the ability to the financial statements, which is the 433A, based upon disposable income. An offer and compromise is the same thing. So what happens if you owe the IRS money? Well, number one, they can file liens. To my knowledge, and from what I've seen in the past 14 years, usually if you owe less than $10,000, a lien is not filed, but over $10,000, it gets filed with the county recorder's office in the county where the taxpayer resides. And what happens there, if you own your own home and you sell it at some point in time, well, there'll be a lien recorded, and therefore the IRS gets paid. A levy, they can levy your bank account, wages, and so forth. So what the IRS can do is, number one, if you owe them money and you don't negotiate a payment plan with them, they can go ahead and put a levy on your wages. It's called a wage garnishment. Usually they'll take 25% of the gross, which is really severe at times. They can go ahead and put a levy on your bank account, and you have 20 days in order to contest it. Otherwise, the money comes out, everything, whatever is in that. I mean, if you owed them 10 grand and you have 5 grand in the bank, the whole $5,000, you might as well kiss it goodbye. So what can we do when you owe the IRS money? Really, it's very simple. Number one, you either establish a monthly payment plan, or secondly, you can submit an offer and compromise. Today we'll be discussing how to establish a payment plan. There's another topic on the offer and compromise that we cover, so please review this one, that topic as well. The first and foremost important thing when you want to establish a payment plan with the IRS is your client must be in full compliance, meaning that all tax returns for all years must be filed. So if they haven't filed for 1 year, 2 years, or several years, or you are unaware or they are unaware, please contact Practitioner Priority Service. We have a topic on that. Go ahead, view it, and it'll tell you exactly what needs to be done. Make sure they get in compliance. Everything is filed to begin with. Secondly, you will need to fill out Form 433A. There's two ways to do that, and the first thing that can happen is there will be a revenue officer from the collection division assigned to the case. If that's the case, you or your client will be informed about it because a letter would have been issued to you. The second one, if your client or yourself owe the IRS money, you can call Practitioner Priority Service and establish a payment plan. Let's mention one thing, and that is ACS, Automated Collection Services. It's the CP 504, that's the letter, call letter. So if you or your client owe the IRS money and they sent you a notice to say, hey, you owe us money, call us. Second notice, third notice, fourth notice, CP 504, giving you 30 days in order to comply, or they will go ahead and do wage garnishments, bank levies, etc. You need to contact them. But again, before you contact ACS, make sure you or your client are in full compliance. if you try to establish a payment plan and you're not getting anywhere with the IRS, you're in full compliance, everything is working out well, but somebody at the IRS wants to take the financials into their own hands and not according to national standards, you can go ahead and file Form 911. You'll be assigned a representative to help you throughout your case. And then again, make sure to also review the innocent spouse below, because if you are an innocent spouse and the IRS is coming after you to take away your money, well, you know, there's things, there are remedies. So let's go ahead and get started and turn over to the form, to the filled-in form 433A. This is really where it all starts. After being in compliance, everything is done. You have only two options: set up a payment plan, submit an offer and compromise. Nothing else works. Or pay it in full if you or your client have the money. So the 433A is very important. And let's go ahead and begin, and we're going to nitpick at it page by page so you can understand. The first page is filled in with name, address, social security number, phone number of the client. Very simple, right to the point. Section 2, again, very simple, right to the point. It's about employment information. Just go ahead and put in here where you work, address, phone number. Section 3, if the individual or sole is the individual or sole proprietorship party to a lawsuit, there's a bunch of questions here. Answer yes, no, whatever have you there. Fourth section, cash on hand. You know, whatever you have on hand in your pocket. You know, $20, $30, $5. Then we get into who you bank with, bank, account number, account balance. Then we get into any investments, stocks, bonds, etc. Available credit. Sometimes they'll look at this if you have a MasterCard or a Visa and your credit limit is $1,000 and you owe $0 and you're able to borrow on it, well, they want that money. So be careful when you are addressing this section here. Use your own judgment. Life insurance, they look at it because if you have a whole life where there's equity in it and you can borrow against it, they will look at that as well. They would want you to borrow the money and submit it to them. Again, very simple.